Most people think money is the thing in their wallet. They are wrong. Money is not the bill. Money is not the app. Money is not the number on the screen. Money is the price of waiting. And the bond market sets that price. If you do not understand that, you do not understand why houses become unaffordable, why stocks look brilliant one year and stupid the next, why companies hire like drunks and then fire like cowards, or why ordinary people keep feeling as if the game changes right before they arrive. I have spent my life watching people stare at the wrong scoreboard. They watch the stock ticker. They watch the Fed headlines. They watch home prices. They watch layoff news. But the real machine is underneath all of it. It is the market that tells the whole country what borrowed money will cost. And when that machine turns hard, everybody pays. I want to make this painfully simple. The United States government took in about $4.9 trillion in tax revenue in 2024. It spent about $6.8 trillion. That left roughly a $1.8 trillion hole, a hole that large does not get patched with optimism. It gets funded with debt. So the government does what every overconfident household, every expanding business, and every politician eventually does. It borrows. That borrowing happens through bonds. A bond is only an IOU with better tailoring. You hand over money today. The borrower promises to pay you interest along the way. Then the borrower returns your original money at the end. That is all in bond language. The original money is principal. The interest is the coupon. The time you must wait is maturity. 3 words: principal, coupon, maturity. If you understand those 3, you already understand more than most people who speak confidently about the economy. But the real trouble does not begin when bonds are born. It begins after they are sold. Because this is where the machine stops looking like accounting and starts looking like power. I want you to hold one mother line in your head for the rest of this story. The bond market is the national pricing engine for risk. That is the mother line. Everything else is only a branch off that trunk. If the price of safe money changes, the price of dangerous money changes. If the price of dangerous money changes, houses change, stocks change, hiring changes, firing changes, confidence changes, and eventually your life changes. That is why this subject matters. Not because it is academic, because it is operational, because it decides who gets to move and who gets stuck. The first mechanism is what I call the yield seesaw. This is the mechanism that humiliates most beginners because it looks trivial until it starts rearranging the whole economy. A bond can pay a fixed coupon and still become more or less attractive every day. That sounds strange until you remember one thing: the cash payment may stay fixed. The price people are willing to pay for that payment does not. Suppose the government issues a bond with a $100 principal and a 3% coupon. That means it pays $3 a year. Simple enough. Now imagine that a few months later, new bonds come out paying 4% on the same $100. Now your old bond looks weak. Why would anyone pay $100 for $3 a year when fresh paper is paying $4? They would not. So the price of the old bond must fall until the return becomes attractive again. If your old bond drops to $70, that same $3 payment now becomes a yield of about 4.2%. $3 divided by 70. Now the ugly old bond has become interesting again. That is the yield seesaw. When price goes down, yield goes up. When price goes up, yield goes down. One definition, one calculation, one example. Now here is the harder judgment. Most people think interest rates are announced from a podium and then politely flow through the system. That is childish. Rates are fought over in the bond market first. Everything else is translation. The second mechanism is what I call the mortgage gate. This is where ordinary families discover that they were never negotiating with the bank in the first place. They thought they were buying a house. In reality, they were bidding for access to debt. Banks do not invent mortgage rates out of thin air. They look at government bond yields, especially long-dated yields, use that as a benchmark, and then add extra compensation because lending to you is riskier than lending to the government. That extra spread is the bank's payment for uncertainty. Your job can disappear. Your income can shrink. The government can print, tax, borrow, and survive longer than you can. That is the brutal comparison in January of 2021. The 10-year Treasury yield was around 1%. Mortgage rates were around 2.65%. Money was almost free. When money gets that cheap, people stop asking what the house is worth. They ask what monthly payment they can survive. That is when prices lose discipline. That is when buyers begin worshiping the payment instead of the asset. The result was predictable. Demand exploded. Home prices jumped about 19% in 1 year over the previous 50 years. The average home price increase was about 4% a year. That 1 year jump was not normal. It was borrowed urgency. It was a cheap money stampede. Then the machine turned. By October 2023, the 10-year yield hit 5%. Mortgage rates moved above 8%. Now buyers suddenly remembered arithmetic. Monthly payments became suffocating, demand weakened. And yet housing prices did not collapse the way many people expected. Why? Because another bond market consequence had already locked the door. Millions of existing homeowners had mortgages near 2% or 3%. Selling meant giving up old cheap debt and replacing it with new expensive debt. So they stayed put. Supply tightened, buyers retreated, sellers refused. The market froze instead of clearing. That is the mortgage gate. One definition, it is the mechanism through which bond yields decide whether housing feels open or barred. One number, around 1% Treasury yield in early 2021 versus 5% in late 2023. One real example, mortgage rates near 2.65%, then over 8%. Now the harder judgment, when people tell you housing is expensive because of greedy sellers, foreign buyers, builders, zoning, or some fashionable villain of the month, they are usually describing branches. The trunk is still the price of money. Cheap debt inflated the market. Expensive debt paralyzed it. The third mechanism is what I call the risk ladder. This one explains why stocks can look unstoppable when bonds are weak and suddenly look ridiculous when bonds grow teeth. Every investor is climbing a ladder of risk. At the bottom sits something safe. In the United States, that usually means government bonds. Higher up the ladder sit stocks, private businesses, speculative assets, and all the glamorous stories people tell when they are feeling brave. The question is never simply, can stocks go up? The real question is, how much extra return do I need to justify leaving safety? That extra reward is the equity risk premium. Again, a fancy term for a simple reality. If a treasury bond gives me 5% with very little risk and I expect stocks to return 7%, then I am only being paid 2% extra to tolerate all the mess that comes with stocks. That 2% may not be enough. But if bonds yield only 1% and I still expect stocks to return 7%, then I am getting a 6% equity risk premium. Now risk suddenly feels seductive. That is not philosophy. That is allocation from 2009 through 2021. We lived through a long era in which rates stayed very low and bonds offered very little. Money kept climbing the ladder. The S&P 500 went from about 600 in 2009 to around 4,700 by the end of 2021. People called it innovation. Some of it was, people called it genius. Some of it was not. A great deal of it was simply the bond market making safety unattractive. Then 2022 came along and new bonds began offering roughly 4%. Investors no longer had to chase every stock story to get a return. They could get paid without all the drama. Money moved. The S&P 500 dropped nearly 20% in a single year. That is the risk ladder, one definition. It is the mechanism that determines how much reward risky assets must offer before investors bother climbing away from safety. One number set, 1% Treasury yield with a 7% stock expectation gives a 6% premium. 5% Treasury yield with the same 7% stock expectation gives only a 2% premium. One real world result, a long bull market under weak bond yields. A sharp repricing once safe yields improved. Now the harder judgment, a lot of investors think they are picking stocks. Very often they are just renting courage from low interest rates. When the bond market offers real yield again, borrowed courage disappears. That is when quality matters. That is when fantasy gets marked down. That is when people learn the difference between an investment and a mood. The fourth mechanism is what I call the refinance trap. This is where the bond market leaves Wall Street and walks into payroll. People love to say companies lay off workers because management became heartless. Sometimes that is true, but often the bond market has already tightened the rope. Many growing companies do not fund expansion from profit alone. They borrow, they sell corporate bonds, they take loans, they finance factories, research, hiring, and expansion with future promises. When rates are low, this feels intelligent. Sometimes it even is. Imagine a company in 2021 when government bonds yield around 1%. That company might issue corporate bonds at 3%. The spread looks manageable. Money is cheap enough to build more plants, hire more workers, and promise a brighter future on quarterly calls. Then time passes, debt matures. Now the company must refinance, but it is no longer 2021. Government bonds now yield around 5%. Investors demand much more from corporate debt. Instead of refinancing at 3%, the company may need to refinance at 7%. That is not a minor inconvenience. That is a doubling of interest expense. And then some, it is as if your rent doubled while your income stood still. So what happens? Budgets get slashed, hiring freezes, projects die, stores close, workers get laid off. Executives call it streamlining. I call it the interest bill arriving. That is the refinance trap. One definition. It is the mechanism through which old cheap debt gets replaced by new expensive debt. Forcing businesses to cut somewhere. One numerical jump, corporate borrowing that once cost 3% can move to 7% when the safe benchmark rises and lenders demand more. One concrete example, a business that expanded aggressively under low rates suddenly faces a much fatter interest expense when its old debt must be rolled. Now the harder judgment, many workers think their paycheck depends only on their performance and their company's revenue. Number in a debt. Heavy economy, your paycheck also depends on whether your employer can refinance without choking. You may believe you work for a software company, a retailer, a manufacturer, or a startup. Sometimes you work for a refinancing schedule. That is the identity flip most people need. You are not merely an employee. You are an indirect bond, market passenger. And if you do not know that, you cannot read the danger early. The fifth mechanism is what I call the spread alarm. This one matters because it tells you when fear is no longer hiding. A government bond is considered safer than a corporate bond. That means a risky company must pay more than the government to attract money. The difference between those two yields is the spread. When investors feel calm, the spread can stay moderate. When fear rises, they demand much more compensation for taking corporate risk. That wider gap is a warning. It tells you that lenders no longer trust business conditions to remain friendly. It tells you that the market is charging more for uncertainty. It tells you that trouble is moving from theory into financing. This matters because the economy runs on confidence, and confidence often breaks in credit before it breaks in headlines. By the time the public sees a wave of layoffs, the financing stress often arrived earlier. The bond market sniffed it first. That is why I respect credit more than commentary. The spread is not interesting because it is technical. It is interesting because it is honest. Stocks can lie to you for a while. Narratives can lie to you for a very long while. Credit usually lies for less time. That is the spread alarm. One definition, it is the widening gap between safe bond yields and risky corporate bond yields when fear enters the system. One practical meaning, a wider spread means companies must pay more to borrow, especially weaker ones. One real consequence, more pressure on hiring, margins, refinancing, and survival. Now, the harder judgment, if you wait for the unemployment report to tell you conditions are worsening, you are late. If you wait for management to admit the balance sheet is stressed, you are late. If you wait for the headlines to agree, you are very late. Credit markets usually get nervous before polite people do. Now step back and look at what these 5 mechanisms are really saying. The yield seesaw prices old debt. The mortgage gate decides who can finance a house. The risk ladder reprices stocks. The refinance trap squeezes employers. The spread alarm warns that fear is becoming expensive. Different names, different doors, one machine. This is why I said we only have one mother line. The bond market is the national pricing engine for risk. Once that line clicks, the economy stops looking random. It starts looking mechanical. And when you can see the machine, you stop confusing symptoms for causes. That alone will save you money. But I want to push further, because understanding the machine is not enough. You need to know where ordinary people get crushed by it. They get crushed in 3 places. First, they borrow long and think short. Second, they buy risk without demanding enough compensation. Third, they build a life that only works when money stays cheap. That third mistake is the killer. A life that only works under cheap money is not a durable life. It is a rate. Sensitive costume. The moment yields rise, the costume tears, the mortgage becomes heavy, the car becomes foolish, the credit card becomes predatory, the growth stock becomes dead money, the employer becomes cautious, the temporary financing plan becomes a permanent drag. Then people say the world changed. Number, the price of money changed. The world merely obeyed. I have seen intelligent people spend 20 years mastering business and spend 0 years mastering financing. That is dangerous. A wonderful business can still get mangled by expensive capital. A wise household can still get trapped by bad timing if it confuses affordability with optimism. A stock can still disappoint even when the company is decent if investors no longer need to tolerate risk for such a small premium. The market is not rewarding stories, it is discounting cash flows. and discount rates are merciless. This is where I want to say something that will offend the wrong kind of investor. If you do not understand bonds, you do not truly understand stocks. You may memorize tickers. You may sound clever at dinner. You may know who launched a product, split a stock, or missed earnings by 2 cents. Fine, but if you do not know what safe yields are doing, what spreads are doing, and what refinancing conditions are becoming, you are trying to fly by staring at the paint. You are watching the decoration, not the engine. Now let me turn this toward action, because knowledge that does not change behavior is entertainment, and entertainment is expensive when money is on the line. What should an ordinary person actually do with this? I will give you an operating system, not a prediction machine, not a trading trick, an operating system. The first rule of the operating system is this: always know the current price of safe money. You do not need to become a bond trader. You do not need exotic models. But you do need to know whether Treasury yields are broadly low, normal, or high relative to the recent environment. If safe yields are rising sharply, assume pressure is moving outward. Assume mortgages will bite harder. Assume weak businesses will feel more strain. Assume speculative assets must work harder to justify themselves. Assume refinancing risk is becoming more serious, not less. That single habit will stop you from making cheerful decisions in a tightening environment. The second rule is this: never judge an asset in isolation. Judge it against its next best alternative. That is how the bond market thinks. That is how disciplined investors think. A stock is not just good. It is good relative to what safe bonds are paying. A house is not just expensive or cheap. It is expensive or cheap relative to the financing terms available. Plan is not just ambitious. It is ambitious relative to the interest cost required to fund it. Everything is relative. People get hurt when they evaluate assets as if capital were free and permanent. It is not. The third rule is this: do not confuse temporary borrowing power with permanent wealth. In cheap money years, people believe they got richer. Sometimes they did. Often they just gained access to larger monthly obligations. That is not the same thing. If your entire plan collapses when rates move a few points, you did not build wealth. You built dependence. The fourth rule is this: demand a margin of safety that reflects the bond market, not your emotions. When safe assets pay almost nothing, you may need to take some risk to get ahead. But when safe assets pay a respectable return, the hurdle for risk should rise. You should become pickier, more selective. More demanding risk is not brave, simply because it is available. The fifth rule is this: watch credit stress before it reaches your front door. If companies in your industry rely heavily on debt, pay attention to refinancing conditions and spreads. You do not need an MBA to understand the practical implication. If borrowing gets expensive, payroll becomes vulnerable. If payroll becomes vulnerable, your personal balance sheet should get stronger before the wave reaches you. That means more cash, less nonsense, and less dependence on perfect conditions. The sixth rule is this: build a life that can survive expensive money. This may be the most important one. A resilient household does not assume low rates forever. It does not assume debt can always be rolled. It does not assume assets only rise. It does not assume employers can always borrow their way through mistakes. It leaves room. It leaves breathing room in the mortgage, breathing room in spending, breathing room in expectations. That room is not laziness. It is strategic oxygen. This operating system sounds simple. That is because the truth usually is, but simple is not the same as easy. Most people want intensity when they should want durability. They want the biggest house payment they can barely carry. They want the fastest stock story in the loudest market. They want the employer growing at any cost. They want the life that looks rich in easy money years and feels fragile in hard money years. That appetite is understandable. It is also expensive. Now, I want to make one more identity shift. People often divide the world into savers, investors, homeowners, workers, and business owners. That is convenient. It is also incomplete in a credit-driven economy. Most people are all of these at once. You are a saver when you hold cash. You are an investor when you buy assets. You are a borrower when you take a mortgage. You are an employee when your company depends on financing. You are a credit risk observer, whether you know it or not. That means the bond market is not some remote institution for professionals. It is a mirror showing how expensive your next decision will be. Ignore it. And you will keep mistaking external pressure for bad luck. Study it, and you begin to see the sequence earlier. That earlier sight is worth a fortune. It helps you recognize when a house payment is becoming a trap rather than an achievement. It helps you see when a stock market surge is being fed by weak alternatives rather than extraordinary fundamentals. It helps you understand why layoffs can arrive even when consumers still seem to be spending. It helps you avoid confusing price with value and momentum with safety. I am not telling you to become obsessed with bonds. I am telling you not to be blind to the things setting the price of money. There is a difference. I do not need you to speak the language of traders. I need you to respect cause and effect. When safe yields are near 1%, almost every risky asset looks prettier than it really is. When safe yields move toward 5%, the mirror changes. The same stock deserves a lower price. The same house deserves a smaller bid. The same company deserves more skepticism. The same worker needs more caution. Nothing mystical happened. The discount rate moved, and because the discount rate moved, the future got repriced. That is the whole game in one sentence. The future gets repriced when the price of money changes. Once you accept that, you will stop asking childish questions like, why did the market suddenly become irrational? The market did not become irrational. You became inattentive. You forgot that value is always being discounted through prevailing rates and perceived risk. You forgot that debt has to roll. You forgot that financing conditions can undo enthusiasm faster than enthusiasm can repair financing conditions. You forgot that a weak bond market can make a strong narrative feel heavier every month. I like businesses. I like productive assets. I like rational optimism. But I do not like pretending that finance is decoration. It is structure, and structure decides how much pressure a building can survive. If you want one final test for whether you truly understand money, use this. When yields rise, can you explain what happens next to mortgages, stocks, and debt? Heavy employers without looking anything up. If the answer is no, then you do not yet understand money. You may understand spending, you may understand saving, you may understand branding, you may even understand headlines, but you do not yet understand money. Because money is not merely what you hold, money is what someone charges for time, safety, and uncertainty. And the bond market is where that charge gets posted. So here is the knife edge conclusion. If you spend your life watching only the assets you want to buy, the bond market will keep ambushing you from behind. It will price your house, humble your portfolio, pressure your employer, and tighten your choices before you even realize the room got smaller. But if you learn to watch the price of safe money first, you stop walking into traps disguised as opportunities. That is not a minor advantage. That is a different life. The people who ignore bonds keep asking why everything got so expensive. The people who understand bonds ask a better question. What is money costing now, and what will that do to every promise built on top of it? Ask that first. Ask it before the house. Ask it before the stock. Ask it before the career move. Ask it before the leverage. Ask it before the story. Because if you do not understand bonds, you do not understand money. And if you do not understand money, sooner or later, money will make an example out of you.